This topic is very important. Mr. Bharath Reddy is a practitioner. He does this for a living, and he's interested in telling you how you can do it very, very well without becoming an expert in all the technology, everything else, but just basic thinking. So, Mr. Reddy went to Amrita University. He was an Amrita School of Business graduate several years ago, and now he is working at HSBC Bank. It is an MNC bank that is very large, and it is headquartered outside of India. But Mr. Reddy handles much of the stock market research to find out what stock should I buy to benefit my own savings. And as you know, you don't need much money to do this, but just be using his advice to get a good benefit. Because everybody will give you tips, but he tells you how to actually do it as a professional, which is what he is. So with that, I will turn it over to Mr. Reddy, to Bharat, so he can begin.
Yep. Thank you, sir. Good afternoon, everyone. Hope everyone is staying safe and doing good. Today, I'll speak on stock market basics. Before I get into that, if any one of you, let's keep it as an interactive session rather than one side me speaking. So if you guys know anything about the stock market or what is a share or what is a stock, you can share the ideas so that we can go from there.
Okay, so Lakshmi, in that situation, why don't you allow everyone to unmute, but keep the video off so that, for them, because it'll be too much bandwidth. Okay, so just unmute everyone. And I ask all our guests to not speak and keep that on mute until you're ready to talk. So
Yes.
go back on mute if you're not Bharat.
Yes, please. If anyone of you know what is just share or what is just stock, what do you know about it? Your thoughts on that?
Hello, Bharat. This is Hemant speaking.
Yes, yes, Hemant.
Yeah, share market is not. It's like buying shares and selling shares. Uh, it happens regularly in between 5 days of in a week. Uh, where these share markets where we invest our money in the company, where company grows,
Hmm. Okay, okay,
where
okay,
we can get some profits by investing our money in that share.
okay, okay.
Yeah.
Yeah. Anybody else? I'll move on. So can you move on, Lakshmi, to the next slide? Yeah, a stock is a share that gives a ownership of a company and a claim on their assets and earnings. If somebody is owning a share of a company, you own that company's future earnings as well as the assets and liabilities. So when you have a share, you you have a right on their assets and earnings, but it is not necessary that they will pay you. The main purpose of why companies issue the stocks to the public, they can do multiple ways to raise the money. Usually they raise the money to expand the business, to reach to the new geographies and new portfolios or new revenue channels. So why they issue? Because to expand that they need a capital. So to get the capital, they issue share. They have multiple ways to raise the capital. They can sell it to the private, or they can go to the banks and raise the money. And the final is they go to the public to offer their shares. Why they go to the public rather than going to the private or to the debt? Private have the private investors may not be able to give the fund the company is expecting to raise. Let's say a company wants to like raise a 10 billion, but investors may not be interested in investing that much of money. And when it comes to the debt, going to the financing with the banks, they have their own constraints in raising the money, so that the companies may not be able to raise the money they want to raise through debt. So as the final resource, they'll come to the public. So they'll issue the shares to the underwriting banks, who will be the primary buyers of the stocks. Then they'll give it to the retailers in a stock market. Stock market, we have multiple stock markets across the world. Every country should have a stock markets to deal with their own companies. So the next question is that why do you invest in a stock? For that matter, whatever you want to do, like investments, what do you expect from that? Basically, it's a return. For any investments, you need a return. If you keep your money in a bank, the return will be, you have some return, but that may not be the so high as compared to other type of investments, because the risk in the bank investment is very low, so the return is. So why do people invest in stock? Lakshmi, can you go to the next slide? What do a shareholder gets out of owning a share? Basically, the share is, from share, the return is the appreciation. Let's say if you buy a stock at 100, if it goes to 125, 130%, 130 USD, that is the appreciation you are getting. But and over and above, some companies, it's not every company that issues the dividend to the shareholders. It's depending upon the companies where they stand. Those companies issue dividend as well. So these are the two primary returns any stock owner would get: the appreciation and the dividend. The next slide, please. Yeah, usually these stocks are available for retail investors like us, individual. You can buy it in the secondary market, which is nothing but a stock market. You can go to any stock broking company, let's say Zerodha, or there are a lot of companies which are as a broker company to sell the stocks. You can open your account, you can buy whatever the company you want and sell it. Those are the markets where you can buy your stock. These are secondary markets. Why do you call it them as a secondary market? Because these are reselling of a stock. The primary shareholding primary issue is with the banks, who initially bought the shares from the company in an IPO, then selling it on to the retailers in the secondary market. This is how the stocks come to the public. But where to invest and how to invest, those are the primary things every individual wants to know about it. As I mentioned earlierly, the return from owning a share is nothing but you have a two ways. One is the appreciation of the stock. Second is the dividend distribution from the company's profits. That not every company would give the dividends. It's up to the companies that they are giving. So the next slide, please. So you can see that the stock market is like the price is changing for every 5 seconds or 10 seconds, depending upon the whatever the stock market has a line, 5 seconds reflection or 10 seconds. This is all happening just because of the supply and demand for any stock. If the supply is very high, and which is means people wants to sell the stock and the buyers are less, so the stock price comes down. And it's the other way around. If the buyers are very high and the sellers are low means the share price will appreciate. But in a long term, what is actually driving any stock? It is actually the fundamentals of any company, how they are doing. Let's say you have two options of a person whom you want to give a money, or you want to invest in two persons. One person is having very wealthy person who is having assets only. The other person is who is having a continuous cash flow. Let's say an employee, but other person, he doesn't have any cash inflow, but he has a assets of what in crores. Usually a person, whom do you pick among, if anybody can answer this question? One person is having a wealth, but he doesn't have inflows. The other person is having, he doesn't have wealth assets, but he has continuous cash flow. Whom do you pick and why? If any thoughts from the floor?
I think that the person must have the cash flow, because if the money is not going and coming in the company, then that company will not survive for so long.
Yes, you're right. You're right. Thank you for that. So to choose a company, you need to know the how the company is doing. They should generate a cash to be in the business. If they are not able to generate the cash, that means some or other day they'll go bankruptcy. They have to generate cash if they want to be in the business. So there are a lot of ways you can look at the company. First thing first is that which industry you are looking at. Let's say we have in the kind of industries we have, let's say everybody knows that the COVID onset is there, so the pharma industry is well known. Then you have automobiles, which are vehicle companies, Maruti Suzuki, Hyundai, these companies. And the pharma companies, you have a lot of Dr. Reddy's and all. And these are the different kind of sectors. Usually these things will be segregated into the sectors. Telecom sectors, which is like Airtel, Zio, Vodafone. It's a basketed into different things, and each industry would be in a different phase of their life. Let's say telecom industry, it has reached the maturity stage. The industry, uh, the population in India has almost 80 to 85% of the Indian population is already into the telecom density. So they have access to the telecommunication, the mobile access. So you don't have many things to grow from there, because you already reached a place where everyone has come to under your radar, your purview. So from there, the companies has to find a innovative products to sell over and above regular calls. Let's say data, let's say videos, let's say audios and all. So that industry is matured industry. That means you don't have anyone who is outside of telecom industry. So they have reached the maturity stage. And another companies, let's say latest fintech companies, fintech, let's say buy now pay later companies are there. You must be knowing about capital float, these razor pay and all. They are new companies, and what their target customers are, the who are unbanked. That means who doesn't have bank access and who doesn't have credit access. So those kind of companies have lot of scope right now, because India has lot of people unbanked, lot of people who doesn't have access to the credit, and these companies are at their very early stage, which means they started like 5 to 6 years back, and they haven't reached the complete population they targeted. So they are at the early stage of the industry. And there will be an industry which is a fast growing industry. uh, even electric vehicles is also an early stage, nascent stage industry, because it has just started. The mass reach has not reached yet. So that industry is also at the very nascent stage. Let's say a food delivery industry like hyper local industry, those are in the growth phase. They have reached a significant user base, but and they are growing at a faster pace. Those are the industries that are at the growth stage. So you need to pick the company, which kind of company you want to pick, whether you want to pick a company at very early stage, or you want to pick a company at the growth stage, or you want to choose a company at the matured industry. Because mature industry, usually the FMCG, fast moving goods, PNG, Hindustan Unilever, those kind of companies, and ITC, those companies usually pay the dividends because they generate the cash, but they don't have other avenues to put in their investment. So they give it back to the investors, whoever invested, be it in retail investors or institutional investors. So you want, for a price appreciation, you usually the price appreciation trends we have seen for decades or centuries usually happens from nascent stage to growth stage. If the companies, this is this is for across the companies, every company in the industry usually grow their stock price in this phase. But if the company is going bad in their strategies, yes, they go down badly, very badly. So you need to choose the companies which you want to invest at what stage industry. And if you see the, can you go to next slide, Lakshmi? Next slide, you have, uh, as I mentioned, next slide. Yes, that's next slide. Yeah. So as I mentioned, the Tesla company, which was earning 73K USD per year in 2007, now they are earning same amount within 45 seconds in 2021. So the company has grown multiple times. So the stock also, it has grown thousands of times in that same period. So when Tesla started, the industry itself is a new industry and they are at the very early stage. So the company, in that kind of company, yes, the people risk themselves. You never know that this kind of company would succeed or not at the very early stage, because the industry itself is a new one. The Tesla had everything that a company should succeed. Those are innovation. They have the innovation capacity, the capital infusion. They were able to sell their company to the private investors and raise the capital, and the customer demand as well. So, and the regulatory part as well. The countries across the world were promoting the electric vehicles and curbing the emissions, GHG emissions. So the company had every ingredient to succeed at that stage in 2007 itself. If some investor had seen all these ingredients in a right perspective, he would have invested then and there itself, way back in 2007. He would have made money multiple times, because the Tesla is making annual revenue of 2007 in 45 seconds in 2021. That is the growth you have seen in the company. And in the same way, we have Evergrande, which is a Chinese company. It's a real estate company. The real estate is emerging markets. It's a growth market. As I already mentioned, when a company is in a growing industry, you need not to say that that stock will grow, because this company had lost 90% of the stock value in last 12 months because their execution and external environment, all of them led to this company's bankruptcy. These company had a debt of around 300 to 400 billion, which they were not able to generate the cash to even meet the interest of those debt value. So it's not that when a company is in a industry, a growing industry, it doesn't have to appreciate their stock, because unless you have a right strategy, you can't have appreciation in the stock. The stock will automatically decline. So the next slide, please. Yes, as I already mentioned, how many times you would have made money had you invested just 1k USD 10 years back? Just imagine Tesla, how much money you had made. 1k is equal to 152k now. And at the same time, another technology companies, the Netflix, the new age technology company, it also made 18k. And Amazon, the giant of e-commerce, and the Microsoft. See, Microsoft and Google were there for long back, but yet they were able to uh, generate their cash and stay relevant in the industry just because of they continue to innovate new products, continue to meet the new age customer demands. That's how you survive. If the company is not able to meet customer demands, they will demise some or other day. Yes, as we can see in the case of Nokia, it was the biggest company way back in 2008 and 2007 time. That was, they were selling most number of mobile phones on the earth, but now we don't know where it is. They filed for a bankruptcy because they lacked the innovation. They were not able to innovate new things as Apple did. So they lost the race and they demised. So my thoughts for you guys is that you can make money in stock market. I'm giving a disclaimer that I'm not here to recommend you any stock or recommend you any industry, but to make money you need to understand the company, and you have to take your own decision on whether this company can grow or not. And the basic things I would look, if you ask me what you would look for a company to get succeeded or the stock would increase over time, is that first one is the management, who are their board members, whether the board members are very well known, whether had they ever led a company and were they successful in that. And the second is, and in which business they are into. If you have a business which is a lot of restrictions, let's say the ITC one, if you see the ITC stock price, it has been around 200 rupees for 3 years or 4 years, because it every year it attracts the government taxes every year, and they so when you have a regulatory issue things, so you need to keep them in mind that if regulatory things are changing, yes, your company will get affected. I'll tell you a classic example on the regulatory thing. You must be knowing about future retail, Amazon and Reliance, the classic case that is going on right now. Future wants to sell their company to Reliance, but the Amazon doesn't want that to happen. They also have a stake in future retailers, their one of the business. So they went on to the court to stop that. And however, Reliance were able to succeed in the Indian court, and again Amazon went on to the Singapore International Court, and there they were able to get their favor. But however, again that case again transferred to Delhi High Court, and this is again into lot of things going on. However, this might go in favor of Reliance or Amazon. So if you see the how stock reacted during that period, future retail stock was somewhere around 160, 170 when 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 the deal was announced. The stock suddenly goes up to 200 rupees because the the deal is favorable to both people, uh, Reliance as well as future retail. That's what the investor perceived. When the Amazon went on to the court, the stock price has declined because this is the news that is affecting the company's future. So when Reliance won the case in domestic courts, yes, again price increased. Again, Amazon went on to the international court. Again, the stock price has come down. So these are the external news, external factors. It need not to be only companies' financial performances that affect the stock price. There are a lot of other factors that affect the stock prices, like these things, the regulatory things. Let's say the classic case is COVID-19. When the COVID-19 started spreading in 2020 March, the stocks have gone down significantly for no reason. Nobody knew that what was the impact of the COVID on any company at that moment, but still stocks have gone down by 40 to 50% just because of fear of investors. They just wanted to pull out the money. They pulled it out, so the stock prices have gone down. So, however, the companies who were resilient to this COVID-19 were came back to the pre-COVID level and even higher and growing stronger now. So, if any short-term hiccups comes up, it doesn't matter. If the company's fundamentals are really strong, it it is going to grow. These external short-term events, yes, they do happen, but it will not impact the long-term perspectives of the company. So I can say that you guys think about it before investing any stock, but you can go either way. You need to be strong. As I already showed that had you invested USD 1K 10 years back in Tesla or Netflix or Amazon, these companies, you would have made multiple times of your money. Had you invested on Evergrande real estate Chinese company, you would have lost everything. So the stock has a risk. Stock always is a risky asset to invest. At the same time, the returns are also multiple times. So I'll stop it here. I'm open for question, but I'm not recommending any stock for you guys, or I'm not recommending any industry for you guys. This is a disclaimer from my side because I have my own compliance thing as I'm into this industry.
Bharath, do you mind turning your video on if you have sufficient bandwidth so they can see you?
Yes, sir.
Thank you.
Yeah. Yes, guys, you can ask me questions.
Okay, if people are waiting to figure out what question to ask, let me ask you a question,
Yes, sir.
which many people might be wondering. You know, my friend tells me I should buy this stock or buy that stock. What do I do with that type of advice?
See, you need to understand what your friend is doing. If is he a professional to recommend you stock, or is just going with the flow? If someone he's just a intraday trader, who is just attracted to what is happening. Somebody made, let's say Rakesh Junjunwala had made so much of money. He heard in the news, and so he wants to invest. He invested, so he recommend you. So you need to understand who is recommending you the stock. He doesn't know the things. He's just going with the fancy things that is happening in the market, or is it really a person who understand the companies? That is more important. Don't go with the people who doesn't understand the market. You will lose money. Please don't do that.
Any other questions for Bharath or Mr. Reddy? No questions? I mean, this is a very attractive area, and once you start having any type of savings, historically, over the last several decades, on the average, stock market returns better than banks and even mostly real estate, except some exceptional areas. It's done very
Yes.
well, but you have to be patient and you have to know what you're doing, because easily it can be the reverse if you don't follow the small advice of being careful and knowing what to do.
Yes.
No questions at all? Nothing? Okay, so let me ask one more or
Yes,
two
sir.
more, and then after that we can call it a day. So the second question is, you are in a very, you talked about a very attractive area, which is on digital payments, fintech, all those type of things.
Yep.
But if you look at big banks today, they're also getting into the same thing because they realize that is where we as consumers want to be. So when you have that situation, when you have a new thing coming with small companies, but the big ones are also now getting in, how do you analyze which is a better stock to buy?
Yeah. Let's see. The big banks, those are under regulatory purview, who can give credit to the people who have the credit history, or let's say if you take Indian perspective, they should have a credit score and all. But these new age fintech people are targeting unbanked people who doesn't have any credit history. Let's say Checkbook, there is a fintech company who is targeting unbanked SMEs. So those companies the banks cannot target because the banks have their own regulations to follow to give any loan. So, however, these banks are partnering with these kind of fintechs to offer loans. However, these fintechs will be at the beneficiary side because every loan would go through these people only. They will earn the commission. But the target customers for a bank is different from the target customers of a fintech.
Thank you. Very good answer. I used to do this for a living. I want to let you know that I didn't do it for very long because I didn't need to.
Okay, that's good.
By age 39, I retired.
Oh,
I was in investments,
okay.
and I entered it after high technology companies. I was working in them.
Okay.
I worked for a total of 9 years in the stock market, and I made more money to not have to work again in this
Oh,
life and many others. So
great.
it's a lucrative topic.
Yeah,
So any
yeah,
other
of course.
questions from anyone? Because many of you may not want the life that I did, but you may want something like that for yourself. Ask
Yeah.
a question that while you have Mr. Bharath here, because this is not easy to get an answer that will be very honest and direct. Most people will answer it to favor what their own agenda is. That is the difficulty with the stock market. Everyone
Yes.
will say according to what they will benefit from. It's a very selfish place.
It's a biased one.
Any other questions? Okay, so why don't I, so Bharat, I think, the audience and myself would like to thank you for, taking your time and your expertise, because obviously, I think so much of you that I know that you can explain things to the world in a much very, very good way. And by explaining simple things like this, people that are ready to hear it will benefit. The people that are not ready to hear it because they would rather continue the way they are will not benefit. It's a different, that benefit for them will happen different time. But what you're saying to me is what all the famous people have done over the last 100 years. And I want to thank you for carrying that wisdom inside you.
Thank you, sir.
So thank you very, very much. And
It's my pleasure to give you.
It's an honor to meet an Amrita graduate that is like you, because all the people here are entering now Amrita in the online program mostly. And I think they can benefit because this is the output, that you have a humble person, but who is very smart. I can tell you right now, his answers were very precise because I was listening to make sure that, we learned something very, very good, and he gave you top-notch information. So thank you very much, man.
Thank you, sir. Thank you.
Sir, sir, is it okay if I ask a question?
Yes,
Always,
please.
Farid sir, so I would like to ask if it is safe to invest in unlisted stocks as a beginner for an amateur who is just starting in stock market. So is it safe to invest in unlisted stocks?
Sorry, I forgot your name. What's your name?
Lakshmi.
Lakshmi.
Yeah, Lakshmi. So for private investments, I don't think so. You will be able to invest because those guys will go through another channels, and the investment per head is very huge. You will not be able to. Let's say, if Indian perspective, you need to invest minimum 10 lakhs. Their investment. So you will not
No,
be
sir.
able. Sorry.
It is as less as 10,000.
Maybe in the new age text would have come. I'm not sure about it, but the investments, if you directly go with the company, yes, you need to invest heavily. The whatever you told that you can invest as low as 1,000, those big guys will buy, and again they are reselling it to the retail guys in a batches. Whatever you guys gives like 1,000 rupees, they accumulate everything and they buy the some portion of the company. That's how it goes.
Thank you, sir.
Yeah. For a private company, I'm just telling you, you need to be very vigilant on the company because they are not public yet. They don't have any financial history that you can see. The information is not public. So you have to be very clear on the company, whether they are into the right place or not. Otherwise, you will lose money. Let's say there are a lot of companies who lost. There are a lot of new age electric vehicle companies had come, but only few survived. Lot of the companies had demised at the very early stage. They could not even come to the Series B funding. So you should be very vigilant on the company when it is a private, because you don't have any information publicly available on them.